Israel's finance ministry says the cost of damage from its 12-day war with Iran will run into the billions of dollars, with funds needed to repair missile-hit buildings and compensate local businesses. Israel's finance minister said the cost of the war could be as high as $12 billion. The economy is already under strain after 20 months of conflict in both the Gaza Strip and in Lebanon. The Bank of Israel also projects economic growth of 3.5% this year, although those numbers could be impacted by the recent war with Iran. Israel says 28 people were killed as the two countries traded missiles, while Iran's government reported 637 deaths. And a look at equities in Israel as well. The TA35 index is up 23% year to date. Stocks unfazed by the recent escalation here in the region and hitting record highs in recent weeks. Israeli stocks dipped after those attacks in October of 2023 before staying elevated, actually outperforming regional equity markets. So let's unpack all of this with Professor Zvi Eckstein. He's the head of the Aaron Institute for Economic Policy. He's also the former deputy governor of the Central Bank of Israel. He joins us live from Tel Aviv this morning. Professor, thank you so much for your time. Welcome to the program. So the Institute has been conducting its own analysis on the cost of this 12-day war. What is your estimate for the total economic impact of this conflict with Iran beyond the direct military expenses?
Well, overall, we know that the key, you can measure it, is in the terms of how much deficit the government really accumulated and what is the debt to GDP. And then in calculation, as you mentioned, there is a difference between the direct military cost, which run about 1/2 to 2/3, depends on the war. With Iran, we think the cost is something like $7 billion the military cost, plus $3 billion the civilian cost. Overall, the war basically increased the debt to GDP probably by the end of this year to something like 70%, which means about 10% of GDP. This is the basically the running cost, you know, the actual cost that has to be paid. Some of the cost will be paid later, especially with respect both the civilian aspect and also the ammunition that we have to pay in the future.
Expand on that for me. You've said Israel's debt to GDP ratio could hit 70 to 80% by the end of 2026. Of course, that is if the most severe scenario materializes. Would you say Israel is already on that trajectory?
No, the Israel now, after the success in Iran, and actually the success is not only military, it's also in terms of the cost, because a lot of the cost has to do with the anti-missiles ammunition, and as more direct missiles are thrown, then the cost is much higher because of the Hetz and the Iron Dome and all the other ammunitions. Israel cost went down dramatically with the war with the Hezbollah because there basically was very few direct missiles that need the most expensive defense that the Air Force is using against these exact missiles. So the cost overall seems at this time to the end of 25 to be only 70% of GDP, much less than what we expected like even half a year ago and more if we have this war with Iran. And that is very good for the economy, and what you see in the stock market and what you see in the Israeli shekel against the dollar is that they are getting strong because the cost has been lower, and therefore the taxes in the near future would be as they are now, and Israel can really overcome it if we finish the war with Gaza and get to a new beginning to the economy and can get out. I don't know if a similar way that we get out of the COVID, but I would say growth above normal for a few years to catch up the reduction in GDP that we observe at this stage.
So, Professor, you're painting quite an optimistic picture here, but taking a step back, how vulnerable would you say Israel's credit rating is at this stage? And are you seeing any signals from markets or from rating agencies that might suggest a downgrade at this point?
I think at this stage, given that the war in Lebanon cost so little, something like, I think the direct military cost was very low, and also the civilian cost was relatively low, and the very low relatively cost with Iran. You know, something like 20 billion shekels of the direct military cost and 10 billion shekels of the civilian cost. This is half of what we expected about a month ago. And given that, the debt to GDP would stay 70%. And given the potential of Israel getting back to the market, so that's a big importance. If we finish the war with Gaza and we get a free export conditions worldwide, and there are no sanctions on Israeli export, and then we see the Israeli high-tech. By the way, the Israeli high-tech already is getting a lot of funding. We just get the funding for the first quarter of 25, which is above normal. So if high-tech sector continues to export and we get growth, we get people back to work, we get the small businesses back to functioning fully, and the economy function back, we expect in 26 to have a growth rate of 4%, and also at 27, with some growth-enhancing policies by the government, we can really get back to the long-time trend of the Israeli economy, which eventually would make a positive outlook for the rating company rather than the negative outlook that we have for all the three rating companies. So what I am expecting is that, especially also politically, that the economy, that the country would stabilize on a unified rule and not getting to judiciary revolution as this government tried to do it before the war. So if all those positive aspects will come up, not to talk about the potential of some kind of normalization with Syria, normalization with Saudi Arabia, and all those, the Abraham Accord following up, Israel has a more optimistic near future than what we have seen about even 2 months ago or a month and a half ago.